If you stay with me all the way to the end of today's episode, you'll understand why one ETF might be perfect for your retirement account, while another could lose money faster than you ever imagined. You'll also learn why saying I invested in an ETF tells me almost nothing about what you actually own. Let's make it make sense.
Intentional, with the money. What do you do with the money? Make it move, make it make sense, make it make sense. This is rooted, we on record.
This is What the Money. I'm Dr. CC Anthony, and around here, we don't just talk about money, we make it make sense. Welcome back to episode 5. Over the last few episodes, we've talked about stocks, we've talked about bonds, we've talked about ETFs, but today we're going a little deeper because here's what happens. Someone hears you should invest in ETFs. So they go online, type ETF in Google, and suddenly there are thousands of choices. Technology ETFs, healthcare ETFs, gold, dividend ETFs, artificial intelligence ETFs, international ETFs, leveraged ETFs, inverse ETFs. And before you know it, you're more confused than when you started. So today, I'm going to simplify it. All right, let's start with What the Money. Last episode, we talked about SpaceX and the excitement surrounding its potential IPO. What fascinated me wasn't just SpaceX, it was what Wall Street did next. Instead of waiting for SpaceX to become publicly traded, investment companies immediately started creating ETFs around the excitement. Think about that for a second. People were so eager to invest in the idea of SpaceX that Wall Street responded by creating products to meet that demand. That's business. Where there's demand, someone usually creates supply. Now, here's where I want you to pay attention. When people hear the word ETF, many assume they're all basically the same, but they're not. Imagine walking into a grocery store. Would you just say, I'm buying food? Well, what kind of food? Vegetables, frozen pizza, organic produce, dessert? They're all food, but they serve very different purposes. ETFs are exactly the same. They're all ETFs, but they're built for different goals. Some are designed to help investors build long-term wealth. Others are designed for very experienced traders making short-term bets. Some own hundreds of companies. Others own only a handful. Some follow the entire market. Others focus on one tiny corner of it. So today's lesson isn't just about ETFs. It's about understanding that the label isn't enough. You need to know what's inside the basket. That's What the Money. Now, let me put this on record. One of the greatest privileges I have as both a professor and a financial advisor is watching people's confidence grow. And it usually happens the same way, not because they're suddenly become experts, not because they memorize financial terms, but because someone finally explained things in plain language. I'll never forget teaching one of my finance classes. One of my students raised their hand and said, Dr. Anthony, I thought investing was only for rich people. That statement has stayed with me because it wasn't a math problem. It wasn't an intelligence problem. It was an education problem. Nobody had ever connected the dots for them. I've had clients tell me, I wish someone had explained this 20 years ago, not because they wanted to become Wall Street traders, but because they wanted to feel confident making everyday financial decisions. And that's exactly why this podcast exists. Not to impress you with financial vocabulary, not to sound smarter than everybody else, but to help you understand enough to ask better questions. Because when you understand what you own, you're less likely to panic, less likely to chase headlines, and much more likely to make decisions based on your goals instead of someone else's excitement. Which brings me to today's lesson. All right, let's make it make sense. Today, we're talking about 4 basic types of ETFs. Think of this like shopping. Every aisle deserves a different purpose. Let's start with the first one, broad market ETFs. Broad market ETFs are probably what most people think of when they hear ETF. These funds try to capture a large portion of the market. For example, an ETF that follows the S&P 500 owns pieces of 500 of America's largest companies. Instead of trying to guess which company will perform the best, you simply own a little bit of all of them. Think about ordering the sampler platter at a restaurant. Instead of choosing one entree, you get a little bit of everything. That's essentially what a broad market ETF does. It's one purchase that gives you exposure to hundreds of companies. That's one reason they've become so popular among long-term investors. Narrow ETFs. Now let's move on to narrow ETFs. Instead of buying the whole restaurant, you're only ordering dessert or only appetizers. You're focusing on one category. A narrow ETF might invest only in technology, only healthcare, only energy, only financial companies, only gold, only real estate, or maybe only companies outside the United States. Some even focus on companies that recently went public through an IPO, like SpaceX. Now, why would someone choose one? Because they believe one particular area of the economy has more opportunity than another. Maybe they believe artificial intelligence will continue growing. Maybe they believe healthcare has a bright future. Maybe they want international exposure. A narrow ETF allows them to invest in that specific area without having to pick individual companies. Let's take a quick ad break. Welcome back. Strategy-based ETFs. So now let's talk about strategy-based ETFs. These are a little different. Instead of simply tracking a group of companies, these ETFs are built with a specific objective in mind. Maybe they want to outperform the market. Maybe they want to benefit if interest rates change. Maybe they focus on dividends. Maybe they follow a very specific investment strategy. Think of strategy ETFs like hiring a tour guide. Instead of wandering through an unfamiliar city on your own, someone has already mapped out a route based on a particular goal. Now, that doesn't automatically make it better. It just means there's a strategy behind how the investments are selected. Some strategy-based ETFs can be excellent long-term investments. Others can become much more complicated. And that brings us to one of the most misunderstood investment products in the market, leveraged ETFs. Leveraged ETFs. Now, these sound exciting, and honestly, that's part of the problem. A leveraged ETF is designed to multiply the daily movement of an investment. Let's say the S&P 500 goes up 1% today. A 2 times leveraged ETF is designed to go up by 2%. A 3 times leveraged ETF about 3%. Sounds amazing until the market goes in the other direction. If the market drops 1%, that same 3 times leveraged ETF could drop about 3%. Leverage magnifies gains, but it also magnifies losses. Now, here's something even more important. Most people think if the market goes up 10%, my 3 times ETF would go up 30%. Not necessarily, and here's why. These funds reset every single day. Every afternoon, the fund essentially starts over for tomorrow. That daily reset means that over weeks or months, the returns can become very different from what people expect because of something called compounding. The longer you hold a leveraged ETF, especially during a volatile market, the more those daily movements begin working against one another. That's why leveraged ETFs were primarily designed for active traders, not long-term investors building retirement portfolios. They're specialized tools, not beginner investments. They're specialized tools, not beginner investments. Here's a personal story. After years of teaching finance and working with clients, most people don't lose money because they aren't smart. They lose money because they feel like they have to chase whatever everyone else is talking about. I've watched people become excited about cryptocurrency, meme stocks, AI, SpaceX, and whatever headline happened to be trending that week. And almost every time, my first question is the same. Can you explain to me what you're buying? Not because I'm trying to quiz them, because understanding comes before confidence. If you can't explain it, you probably shouldn't own it. There's nothing wrong with just saying, I don't understand this yet. That's actually one of the smartest things an investor can say, because curiosity leads to education, and education leads to confidence, and confidence leads to better financial decisions. So let's put everything together. Broad ETFs, think of the whole neighborhood. Narrow ETFs, think of one street. Strategy ETFs, think of a GPS program to reach a specific destination. Leverage ETFs, think of driving a race car. Can you drive one? Sure. Should everyone? Probably not. Every ETF has a purpose. The key isn't buying an ETF. The key is buying the right ETF for your goals, your timeline, your comfort with risk. And remember, an ETF is simply the vehicle where you're trying to go. That's the investment strategy. You can find the article at the center of today's episode on the feed of my website. This podcast was created for the people who were never taught, but always capable, for the ones figuring it out in real time, for the ones building something out of nothing. This is where confusion gets replaced with clarity, where money stops feeling intimidating and starts feeling intentional. I'm Dr. CC Anthony, and this is What the Money. Thanks for listening to today's episode of What the Money. I hope today helped you better understand the different types of ETFs, how they work, and why understanding what you own is just as important as deciding to invest. If you enjoyed today's episode, make sure you follow, like, comment, share, and if you're watching on YouTube, subscribe. All the little things help the algorithm push this content to more people so we can continue making financial education accessible, relatable, and real. And if you have a money question you want answered on a future episode, you can send me a direct message from my website. My contact information is below in our show notes and at the end of this video. Your question may be featured on the show. Stay rooted, grow intentionally. The opinions expressed herein are for general information only and are not necessarily the opinions of Osaic Wealth or its representatives. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation. Securities and investment advisory services offered through Osaic Wealth Inc., member FINRA/SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. Osaic Wealth does not provide tax or legal advice.
Yeah, yeah. Yeah, what the money? What it do? Break it down, make it move. If it's talking, we translate. Make it make sense. This is rooted. Let me put it on record. With the money, yeah, we watching how it's moving. Make it make sense. Yeah, we breaking down the message. Stay rooted. Grow intentional. With the money. What it do? With the money. Make it move. Make it make sense. Make it make sense. This is rooted. We on record. Nothing moves alone, yeah, it's all connected. Check the pattern, then respect it. What you plan here shows up later. Small steps now turn into acres. With the money, yeah, we watching how it's moving. Make it make sense. Yeah, we breaking down the message. Stay rooted. Grow intentional. With the money. What it do? With the money. Make it move. Make it make sense. Make it make sense. This is rooted. We on record. Nothing moves alone. We feel the truth. Every choice got roots and proof. Stay rooted. Grow intentional. What the money? What it do? What the money? Make it move. Make it make sense. Make it make sense. This is rooted. We on record. mm, mm.